Okay, let's get back to the prospect of new pipelines in Canada. There is a three-way dance going on among the Prime Minister, Mr. Carney, Alberta's Premier, Danielle Smith, and the BC Premier, David Eby, over the issue of building new pipelines through BC.
We are making a very, very strong case that building a new pipeline to Asian markets is in the national interest. We are finding some receptivity on the part of the new Prime Minister, and I would say if we're going to get a deal, it will be in a matter of weeks.
Why did a pipeline that struggled for years suddenly surge to near full capacity almost overnight? And why is this happening just as global oil supply is tightening and the United States heads toward a high-stakes trade review with Canada in April 2026? Canada's Trans Mountain expansion is now operating in the high 90% range, moving close to its full capacity of 890,000 barrels per day, even though most projections had placed that point at least 1 to 2 years later. Analysts had expected 2027 as a realistic timeline, with some even suggesting 2028 if market conditions remained weak. And that gap between what was expected and what actually happened is exactly what makes this moment so significant. This is not a slow ramp-up or a steady increase driven by long-term contracts. Instead, it is a rapid surge that forced the market to adjust almost immediately. And the cause of that surge highlights just how fragile global oil supply chains can become under pressure. To understand why this shift matters, the history of Trans Mountain cannot be overlooked because this project was never viewed as a guaranteed success. The original pipeline dates back to the 1950s and carried roughly 300,000 barrels per day from Alberta to the Pacific coast, but the expansion increased that number to 890,000 barrels per day, effectively tripling capacity while also increasing the risks. Costs climbed to around $34 billion, nearly 5 times early estimates, driven by regulatory challenges, environmental opposition, pandemic delays, flooding, and extended indigenous consultations that pushed timelines far beyond expectations. By 2018, Kinder Morgan were prepared to walk away from the project entirely, forcing the Canadian federal government to step in and purchase it, turning it into a publicly owned asset that many believe might never justify its cost. Even after construction finished and the expanded pipeline became operational in 2024, the numbers did not immediately inspire confidence. Through much of 2025, utilization hovered around 82 to 84%, meaning the system was moving roughly 730,000 to 750,000 barrels per day instead of its full 890,000 capacity. For an asset of that size, underperformance raised serious concerns about demand, pricing competitiveness, and whether global buyers would consistently choose Canadian crude over other sources. Internal forecasts reflected that uncertainty, with leadership suggesting full utilization might not be reached until at least 2027, reinforcing the belief that the pipeline would take years to demonstrate its value. Then everything shifted within days, and the global energy system was forced into a rapid reassessment. A major escalation in the Middle East disrupted one of the most critical oil transit routes in the world, the Strait of Hormuz, which typically handles around 20% of global oil trade, or roughly 20 million barrels per day. When that flow was suddenly constrained, some of the largest oil-importing nations, including China, India, Japan, and South Korea, were left scrambling to secure alternative supply at scale. This was not a gradual shift in demand. It was an immediate shock that pushed buyers to look beyond their traditional suppliers almost overnight. That is where Trans Mountain became central to the story because it was already built, already linked to Pacific markets, and capable of moving large volumes without delay. Within weeks, utilization jumped from the low 80% range into the high 90s, effectively pulling forward the pipeline's full capacity timeline by 1 to 2 years. This was not driven by new policy moves or long-term planning in Ottawa. It was driven by global necessity because when supply chains break, existing infrastructure becomes the only practical solution. Canada did not need to construct a new export route or negotiate new access. It already had the system in place, and that made all the difference. As demand shifted, the destination of Canadian crude began to evolve as well, with a large portion of Trans Mountain shipments moving toward Asia. More than 60% of volumes have been heading to countries like China, where refineries have been replacing disrupted Middle Eastern supply with Canadian barrels. These are not theoretical flows or future projections. This is oil actively being loaded onto tankers and shipped across the Pacific, showing that Canada's long-discussed strategy of diversifying away from U.S. dependence is already unfolding in real time. The pipeline is not just full, it is filled with international demand that did not exist at this scale just a year earlier. That shift carries implications far beyond the energy sector because it introduces a level of flexibility that Canada has not had in past trade disputes. The United States still imports approximately 4.4 million barrels per day of Canadian crude, accounting for around 63% of its total crude imports. Much of that supply feeds Gulf Coast refineries designed specifically for heavy crude like Alberta's. Those facilities cannot easily switch to lighter oil without major engineering changes that would take years to complete, meaning the U.S. cannot quickly replace Canadian supply in the short term. At the same time, Canada is now showing that it can redirect large volumes elsewhere, creating a dynamic where dependency is no longer one-sided. The timing of this shift becomes even more important when viewed alongside upcoming trade negotiations, particularly the CUSMA review scheduled for July 1st. In earlier period of tension, Canada's reliance on the U.S. market acted as a structural limit on how far it could push back, because losing access to American refineries would have had immediate economic consequences. Now, with Trans Mountain operating near full capacity and sending much of its incremental volume overseas, that ceiling is beginning to weaken. Canada is entering negotiations with clear evidence that alternative markets are not only available but already functioning at scale. At the same time, new infrastructure projects are starting to shape the next phase of the transition, adding another layer to the equation. The proposed Prairie Connector pipeline aims to move around 450,000 barrels per day from Alberta to key U.S. hubs like Cushing, Oklahoma, and the Gulf Coast, creating an additional pathway for heavy crude to reach American refineries. The commercial assessment process of this project is currently underway, with decisions expected in the coming months, and its timing aligns closely with ongoing trade discussions, adding pressure on both sides of the negotiation. Beyond that, there are plans to further expand Canada's Pacific export capacity, including a proposed Northwest Coast pipeline that could carry up to 1 million barrels per day if approved and built. While no final investment decision has been made, the fact that Trans Mountain is already operating near full capacity strengthens a business case significantly because it demonstrates real demand for Canadian crude in Asian markets. At the same time, more immediate gains are coming from optimization efforts on existing systems such as Enbridge Mainline Network, which is expected to add around 150,000 barrels per day of capacity by 2027. When all of these projects are combined, the numbers scale quickly because Canada is already producing roughly 5 million barrels per day from its oil sands, and the addition of up to 2 million barrels per day in new or expanded pipeline capacity would significantly increase its ability to access global markets. This is not a minor adjustment. It represents a structural shift in how Canadian energy is distributed, with implications for pricing, trade flows, and geopolitical influence. The more routes that exist, the more options producers have, and the less any single market can dictate terms. For the United States, this creates a complex scenario because while it remains heavily dependent on Canadian crude, it is also watching Canada develop the ability to redirect that supply elsewhere. Gulf Coast refineries cannot quickly adapt to alternative feedstocks, and with global supply already tight, competition for heavy crude is increasing. This means that even as political tensions rise, the physical realities of energy infrastructure limit how much pressure can be applied without creating unintended consequences for American industries. Within Canada, there's also an ongoing debate about how to approach future expansion because building entirely new pipelines can cost tens of billions of dollars and take years to complete, while optimizing existing infrastructure offers a faster and more cost-effective path. For example, increasing Trans Mountain capacity by an additional 200,000 to 300,000 barrels per day through technical upgrades could deliver meaningful gains without the same level of financial risk. These decisions will shape how Canada balances growth with efficiency in the years ahead. At the same time, higher oil prices, which have climbed above $100 per barrel during recent disruptions, create both opportunities and challenges. While producers benefit from higher revenues, consumers face increased fuel and energy costs, adding inflationary pressure to an already strained economic environment. These trade-offs highlight the complexity of energy policy, where gains in one area often come with costs in another, and no single solution resolves every concern. Even with those uncertainties, one thing has become clear. The events of 2026 have fundamentally reshaped how Canada fits into the global energy system. A pipeline once viewed as overbuilt is now operating near full capacity, sending most of its incremental output to international markets and proving that diversification is not a distant goal. It is already underway. That shift changes the balance of power in subtle but meaningful ways, particularly as trade negotiations approach and both sides reassess their positions. Moreover, as tensions between the United States and Israel on one side and Iran on the other stretched over weeks before a temporary pause for negotiations, the effects extended far beyond the battlefield and into the foundations of the global financial system, where Iran and China began advancing a shared objective that had been developing quietly for years. That objective centers on weakening the dominance of the US dollar, a currency that has long served as a backbone of global trade, especially in energy markets where roughly 80% of oil transactions are still priced and settled in dollars, according to estimates from JP Morgan. The timing of this push is not accidental because periods of instability often expose weaknesses in systems that once seemed unshakable. And both Tehran and Beijing appear to be using this disruption as an opportunity to accelerate a shift that has been discussed for decades but rarely tested at scale. At the center of this strategy lies one of the most critical choke points in global energy, the Strait of Hormuz, a narrow passage responsible for carrying about 1/5 of the world's oil and liquefied natural gas supply. Control over such a vital route does not only influence shipping lanes or insurance costs. It creates leverage over how energy is priced and settled, and Iran has begun using that leverage in a way that signals a deeper financial ambition. Reports suggest that some commercial vessels moving through the strait have been required to pay transit-related charges in Chinese yuan, effectively introducing an alternative currency into one of the most dollar-dominated sectors in the global economy. While the number of transactions remains limited, with at least 2 confirmed payments as of late March, the symbolic impact carries far more significance than the volume itself because it shows that oil-linked transactions can occur outside the dollar system under the right conditions. This development reflects a growing alignment between Iran and China that extends beyond short-term coordination and ties directly into their broader economic relationship. The two countries formalized a 25-year strategic partnership in 2021, and since then, trade between them has expanded significantly, with China purchasing more than 80% of Iran's oil exports, often at discounted rates believed to be facilitated through UAE-based arrangements. In return, Iran relies heavily on Chinese imports, including machinery, industrial equipment, electronics, and chemicals, creating a trade relationship that is relatively balanced and less dependent on external financial systems. This kind of bilateral structure reduces exposure to U.S. sanctions, which are typically enforced through the dollar-based financial network, and allows both sides to operate with greater autonomy in a constrained global environment. Despite the ongoing conflict, oil flows between Iran and China have remained remarkably steady, suggesting that this financial and trade arrangement has resilience even under pressure. Data from analytics firms shows that Iran exported between 12 million and 13.7 million barrels of crude in the first 2 weeks of the conflict alone, with most of that volume heading toward China. This consistency highlights an important point because while geopolitical tensions often disrupt supply chains, they can also reinforce alternative systems that are already in place, especially when those systems provide advantages in cost, access, and political alignment. In this case, the use of yuan is not just a workaround. It is gradually becoming normalized within a specific segment of the oil market. For China, this shift aligns with a long-standing ambition to elevate the yuan into a global currency capable of competing with the dollar in international trade and reserves. President Xi Jinping has openly stated the goal of expanding the yuan's role in global commerce and eventually achieving reserve currency status. Moves like this, even if small in scale, contribute to that broader strategy. For Iran, the motivation is more immediate because reducing reliance on the dollar helps shield its economy from sanctions while strengthening ties with its most important trading partner. The result is a situation where both sides benefit, one by advancing a strategic objective, and the other by easing external economic pressure. Even so, the path toward a true alternative to the dollar remains challenging because the yuan still faces structural limitations that prevent it from matching the flexibility and global acceptance of the U.S. currency. Unlike the dollar, the yuan is not freely convertible, meaning it cannot be easily exchanged or moved across borders without restrictions. And China's tight control over its financial system creates uncertainty for international investors and institutions. These factors limit the currency's appeal globally, even as its use grows in certain regions and sectors. Current data reflects that gap clearly, with the dollar still accounting for about 57% of global foreign exchange reserves compared to roughly 20% for the euro and only around 2% for the yuan. While cross-border trade settled in yuan reached about 3.7% in 2024, up from less than 1% in 2012. Because of these constraints, most analysts view the rise of the yuan not as an immediate threat to the dollar's dominance, but as a gradual shift that could reshape parts of the financial system over time. The introduction of yuan-based transactions in the Strait of Hormuz does not overturn the current system, but it adds pressure at the margins and signals that alternatives are becoming more viable under certain conditions. For a full-scale shift to take place, major oil producers in the Gulf would need to adopt similar practices, which would represent a much larger break from the system established in the 1970s when Saudi Arabia agreed to price oil exclusively in dollars in exchange for U.S. security guarantees. Still, The dynamics at play suggest that even small changes can build over time, especially when supported by strong trade relationships and complementary economic structures. China's position as the world's largest manufacturer gives it a unique advantage because it can supply a wide range of goods that oil-producing countries need, creating a more self-contained trade ecosystem that reduces reliance on external partners. This is something previous challenges to the dollar, such as Europe or Japan, were unable to fully achieve, limiting their ability to offer a complete alternative. The broader implication is that the global financial system may not change through a single dramatic event, but through a series of gradual adjustments that reshape how trade is conducted in key sectors. As more transactions occur outside the dollar system, even at a limited scale, they contribute to a slow erosion of its dominance rather than an immediate replacement. The outcome will depend heavily on how current geopolitical tensions evolve, because prolonged instability could encourage more countries to diversify their financial arrangements, while a return to stability might reinforce the existing system for a longer period. In the end, the direction of this shift remains uncertain, shaped by both economic realities and political developments that are still unfolding, and the balance between continuity and change will likely define the next phase of global finance. If current trends continue and alternative systems gain traction, the dollar's dominance could gradually weaken as more countries seek to protect themselves from external pressure. But if the United States manages to stabilize key regions and maintain confidence in its financial system, the existing order could persist longer than many expect, preserving dollar hegemony for the foreseeable future.